This is part 2 to mastering home ownership for property buyers. Now in the first part, we talk about how to identify your budget, and in today's episode, we're going to be talking about how to keep track and label every single cent that you put into the property. Now for the sake of classification, we're just going to call it equity. Whatever money that you put into the property via cash or CPF, we're going to call it equity. And under the equity umbrella, there are 3 different things you need to understand. Number 1 is cost. Number 2 is principal. Lastly is outlay. So let's assume you buy a property at $1 million, which means you're going to take a loan of $750,000. So that becomes your outstanding loan. So 6% is the roundabout cost to making the transaction happen, meaning to say the cost to enter, which you need to pay a 4% stamp duty, and when you're selling it, you need to pay a 2% agent fees. Now this is just 2 of the 8 costs that I'm calculating for simplicity's sake. So all in all, when you buy a property, there are 4 recurring costs and 4 one-time costs. You can take a screenshot if this is important for you. So very simply put, the moment you buy a $1 million property, you are essentially paying $1,060,000 because that is the cost required to enter and to exit this transaction. So the 3 things that we want to understand is the principal. $250,000 because 25% is your down payment. And your down payment is something that you can get back if you were to sell your property at $1 million. So $1 million minus your outstanding loan of $750,000, you actually get back your principal. And of course, the only way to get your cost back is if you're able to sell your property above and beyond every single cent that you have sunk into this property. So your outlay is basically principal plus cost plus down payment, and this is outlay. So not every single cent that you put into your property is an expenditure. The only expenditure that you're going to have buying a property is if you are not able to sell your property at a price high enough to cover the cost that you've sunk into this property. So this is how you should label and keep track of every single cent that you put into the property. And if you have stayed to this part of the video, I'm going to give you a bonus tip right now. It is very common for property marketers out there make it sound like buying a property is extremely easy and achievable by telling you all you need to cough out is the down payment. So now that you understand the 3 different components of money that you've got to put into before buying a property, you can immediately tell whether or not these marketers are just using it as a tagline or are these facts. So that's all for today's video. Stay tuned to part 3.